So, hello everyone. Today we're going to look at some of the Fibonacci ratios that we actually use for retracements and at finding support levels or resistance levels in the market. And how it's used is that you take a low point and you measure up to a high level, and then you will automatically get Fibonacci ratios here on the downside, where support levels will usually kick in. And what we can see is that you get usually the bigger moves, since the market has a tendency sometimes to move in different waves higher, call these waves, or price movements. So here you have one wave, you have a correction, you have another upturn, you have a correction, you have another move higher, and then a bigger correction. There's actually a theory called Elliott waves that take this into consideration, and what we can observe is that if the market is actually behaving in a normal way, so to speak, it's not being manipulated too much, then you will actually get these kind of waves, and it has some kind of a, let's say, potential to predict where the price might go next. And after a big wave like this, or a big price movement, you usually get also a bigger correction. And what usually happens is that it will stop at this 38.2% retracement, and or 50 or 61.8. So of course you never know in advance where it might stop, but this would be a support zone where you would then make a decision for the future, and which you know, how much to buy or what to do next. In this case, this is on Bitcoin on the daily. We can see that from kind of these lower levels here up to 12,900. I didn't include these spikes. You can do that if you want, but sometimes some newer theories say you should you can just include kind of where the most heavy price movement was taking place, and not these final spikes higher. Usually what we would see is, you know, if we only retrace to the 38.2 retracement, it means that if we continue higher, it will usually be a kind of a smaller movement here higher. If we, however, get let's say like we had here, from here to here, it corrected quite a lot. You will get a bigger move once it keeps on going, which it kind of did here. You will get a bigger move afterwards. We can have a look at that afterwards as well, but it's an interesting tool just to use also for the amateur, because you never know where it's gonna stop. But you know that if you rally from this point, or the 60, especially the 61.8% Fibonacci number, then you have a very good chance that the price will actually explode afterwards. So now we can see there's really not a whole lot going on here. We're in a range, and we will see what happens next. Let's take this away for a second and just have a look at this. This is the daily chart, and let's just see from this low here to this top here. And so if we measure from the low here, and we take to the higher level up there, you can see that, funny enough, the correction, oh, now I got another one here. The correction here was exactly the 61.8% level, and that should tell us that it's probably a second wave, which means that, you know, you have the first wave here, you have the second wave here, and then you should expect a third wave higher, 3, 4, 5, and after 5 waves you get a correction A, B, C, and then maybe it's a more complex correction as well afterwards, but the trend might continue after a while. So this is just one way of kind of, I mean, we don't know down here what's going to happen next, but once you see this and the prices move higher here, you can kind of assume that, okay, fine, now this is over and we're looking at a bigger move higher. And this can be used in almost every market, well, in every market. So the trick is really only to try to find the 50% or the 61.8% retracement levels. If you can do that, if you can scan for these things, then you will have a multitude of markets and time frames where you can actually get in at interesting levels, and where you afterwards can you have a very good what shall we say, kind of a probability that the price will then continue higher. And so this can be used on you know, if you look at gold here, for example, let's look at and of course the best is when after a decline, when prices start to move higher again, that's when you will catch these kind of trend changes. And why would you do that? Well, it's because after a certain trend, and when the trend changes, you might actually be in for kind of a snapback higher, and this is where you make the most profits from. So it's kind of it's just a kind of a low risk, high profit setup, and that's why I like it. And here we go. If we look at let's take the this is the gold trust, gold shares, the spider of the gold. And but actually let's look at the spot price, gold price. And we can see here you actually had this green area here where it trades below the 200 Bollinger Bands and then moves higher from there. It is it's in itself a buy signal as well. And if we then look at the Fibonacci as well, we can measure it from this level maybe here. Once you really need to get like a powerful move higher. So if we take this low level here and we measure it up here, so what we can see here on the gold spot is that we moved from the lows up to here, and then we had a correction lower, and we basically stopped at the 78.6. So it's in this, it's almost a little bit too much, a little bit too far down, but it's still in this support area, this lower part, where this is where you want it to turn around. And on top of that, you had this D-Mark 13, which I'm not going to get into now, but it's a separate buy signal, a 13. So that combination with that, plus that you know, you will not automatically buy at this level. You will wait until you get green bars like this when the price moves higher, and that's when you will actually step in and make the purchase. So it's not automatic where once it goes down here you automatically buy. So you would have to you would have to wait for some positive price action before you actually jump in. And that's what you had here. So this would be the first clue here that things are starting to turn around. So if you're a bit more conservative, you would wait for maybe a movement up to here before you actually say, okay, this was the first move, this was the second, and now we're in a third wave here, which is going to carry us a lot higher, and which is exactly what happened afterwards until kind of the next correction. So it's only it can be difficult to predict all of these movements here, but it's really just measuring and seeing where does it stop, where can I use this technique to get in and then get out again, and to find good entry points. The exit point you will have to choose. You can actually calculate a little bit as well, where it will end, and which is also interesting, but I won't get into that now. So we're just looking at the entry point, and let's see another market. Maybe with the recent Brexit talks, there's The sterling has been going lower. Might actually be setting up some kind of a buy signal here after this collapse. We're still in this green, and we might get a snapback higher here to 127 or something like this. Let's see, what can we find out something about this? Maybe we can take the top, but since the trend is down, right? This is a downtrend. You would then look for also, you know, if you get a rally like this and a down move, and then you get a rebound, you wouldn't say automatically, oh, this is a buy signal. It would be more a rebound in a downtrend, and you would look to kind of go short again or something like this. So if you measure from here, let's take, this is also the daily. So if we take this level here, we measure it down to the lows here, we can see that this move here, let me just get rid of this, that this move lower here, this is also a perfect setup. From the top here down to the bottom here, you also have a 61.8 retracement level here, up here, which you know, and then a down move. So you always need this as well in case it continues higher here, which is impossible to know. You want to have price confirmation that the trend down is actually continuing. So then we had this, and so then at this point you can say, okay, fine, now you know, the trend lower is probably continuing here, and especially since you had resistance at the 61.8 Fibonacci. So also kind of a good tool in downtrends, as we can see here on the sterling. So now we looked at the sterling, and that's a currency, and we looked at gold, and we also had a look at Bitcoin as well. And so you see, this can be used on any market in the entire world. This is kind of a universal signal for trading or for investing as well, to finding low risk, high reward trades. What else can we, if we look at the NASDAQ, we have, actually it's probably an interesting situation right now. I haven't looked at this index at all actually lately, but if we take the top here, we measure it down to the lows here, we can see that currently we have retraced about yeah, it's about this 61.8 again. So from the top here you had a first decline down, and now we had an ABC, as they call it, higher up to this resistance area, this Fibonacci number, and now it's kind of, we still have to wait and see here what happens. Should we continue lower here, it probably means we're in for another move lower. If we take this out on the upside, then most likely, because we can only talk in probabilities, then most likely we will see another test higher here, maybe a double top or maybe an overshoot higher. So we're not really, we wouldn't do anything special right here. We would just wait and see, but we would more prepare for a decline here than a continuation higher. But like I said, you never know in advance where it might go, so it really depends on your risk appetite and how conservative you want to play it, and where you place the stop losses and so on. So okay, that's I think I'm gonna stop there. We covered that Fibonacci now, and you should have a little bit of an idea of what it's about, and we can continue on that later on as well. We'll continue maybe in a few days time to see some other kind of setups or methods that can be used in this area. And in the meantime, I think if we look at the crypto market here, it's still kind of in hold mode. I'm not overly excited at the moment. We're still in this consolidation, so we'll have to wait and see what happens here. And that's it for now.